Hello, everyone, and welcome to my podcast called the Palumbo Podcast. My name is Philip Palumbo, and we interview some of the most successful business people to learn about their journey and, most importantly, about their specific expertise. So I want to welcome Andrew Clinton. Andrew Clinton of Clinton Investment Management. He has close to 30 years experience in capital markets and specifically fixed income and specifically tax-exempt municipal bond securities. His career started at UBS, where he was there for 15 years, managing over $4.5 billion in institutional corporate cash management, as well as municipal bonds. And he started his own firm approximately 15 years ago, working specifically with high net worth, ultra high net worth, and family offices managing predominantly municipal bond securities. So we're super excited, Andrew, to have you here today. Thank you for thank you for agreeing to come on board with us here today.
My pleasure. Thank you for having me.
And congratulations on all your success.
Thank you very much.
It's been a pleasure working with you. You know, as you and I have had several dialogues with our clients and you assisting my firm. So we appreciate that very much.
My pleasure. You guys are wonderful clients and your clients are wonderful clients. So we appreciate your ongoing confidence.
Awesome. Thank you, Andrew. So the way I always like to start this off, because you've had a great career, right? Incredible career. So I always like to find out, when you think about when you were younger, was there anything that inspired you, motivated you, that helped you get to where you are today?
Yeah, it's a great question. And I'm not just saying that. It is really a great question because it sort of harkens back to how you've grown up, how you've been raised, the nature and the environment you've been in. So I was very fortunate that I had a very strong nuclear family, mom and dad, who obviously were there and supportive, but also very firm and required discipline of their children and focus. So at a pretty young age, I understood the meaning, not only the meaning, but also the necessity of hard work and a requirement to be focused on personal responsibility, right? Accountability was something that was endemic to our family structure. And that was taught to me at a very young age. So throughout my childhood, through my academics, certainly I was also involved in sports and athletics in college. All of those themes were very, very important to both my own personal development as well as professional development.
That's terrific. Awesome. Was there any mentor that helped you throughout your life that you can remember that, is there one or two people that you go to even till today that has really made a difference in your career?
Yeah, I'm gonna be very honest and say that I had a ton of mentors, throughout my life. Certainly I mentioned my parents were obviously important, but teachers and coaches and really friends, and candidly, those friends, not just those that are fun to be with, but the ones who are really, really strongly willing to hold you to task when you don't behave well,
right?
Perhaps, or not as intended, especially at a young age, to keep you in line. Those are really important, certainly. But, I say, I think for me anyway, and it was just my experience, I know others would have a different experience, but sports and athletics was really an important lesson for me. It certainly taught me a lot about myself in the context of how to meet and navigate failure in particular. It's easy to be a good winner, right? It's very challenging to be a good loser and learn from your mistakes. And it's something that on a day-to-day basis, we challenge ourselves with, even today, in environments and market environments that are highly volatile. We try to make the best decisions possible for our clients and try to keep their interests first in everything that we do. But we're also very much human in the sense that we don't have a crystal ball, and we ultimately try to focus our time and attention in a way that we think will give us the best outcomes. But at the end of the day, we also know that if there is instances where we're not 100% correct, as we're not expecting to be, but we want to make sure that our clients understand that we're accountable. We understand where we made our mistakes and how we're going to not make those mistakes in the future and how to learn from those experiences. So certainly athletics for me was a big part of that learning experience.
So awesome to hear you say that, right? So literally I was just talking to somebody had asked me, we're talking about, I coach lacrosse. I think I told you that perhaps. I played Division I lacrosse, and we were talking about what's going on in the lacrosse world, our children. I have 3 boys, as you know. And it's like, Phil, why do you get so crazy about lacrosse. It's just lacrosse. And in my head, I'm like, and I started to say this to him, it's not just lacrosse, it's the experience and what athletics does to you and how it helps you throughout your life, the grit that you learn, right? The accountability.
Mhm.
And there are times when you go through lows in sports, right? And you say, gosh,
Absolutely.
I really do this. And then you fight, and all of a sudden you start to now then move up. And that experience at a young age and carrying that throughout your life, there is no doubt in my mind. I just told to my wife literally the other day. There's no doubt in my mind that if it wasn't for athletics, there's no way I'd be where I am at today. There,
Right.
there's just
Right.
no way, because I just learned at such a young age, just the grit, the accountability, the work ethic, and it stayed with me to until today. And I was like actually going to ask you about your athletic career, and you just answered it. So it's great to hear, and especially in what we do for a living, right, which is capital markets, and it's not easy, as you know, right, the day to
Yeah,
day.
it's a competitive universe. There's lots of people that do what we do, and we're constantly trying to be the best in what we do. And ultimately, I think the other part of athletics, which I think is interesting, is that obviously the teamwork component, which everybody really, I think, understands and maybe doesn't think enough about, but it really does take a team. And I'm very grateful that we have a really great team here. With their support and the strength of that team and experience, you get a great deal of confidence as a firm, right? And for us, ultimately, hiring is a big part of our success. Getting good people here at Clinton Investment Management is so important to our future, to our clients' future. And so we take that decision very seriously. And so, because it's important not just to know how to learn from your mistakes, but also to recognize where success comes from, right? And as we grow as a firm, I know fully that the growth of our business is really not my personal success, but our collective success, right? And it's that notion and that framework that I think really drives all of us to do well, no matter what role we're in on a day-to-day.
I agree with you. One thing, Andrew, I really want to get across to my audience, which I think is super, super helpful, right? So you were at UBS for 15 years, managing $4.5 billion. I'm sure from an income standpoint, so the economics, I'm sure were very stellar for you if you stayed at UBS. But something happened where you said, I want to go off on my own and build my own firm, as you did, and as you've had incredible success. So walk me through what the mindset was, and that mindset, and what you can share with my audience on how, if they do want to do something on their own, how they should be thinking.
Yeah, it comes back to a seminal moment for me. I have a mentor, and you mentioned mentors. I would say a colleague, close friend who I've known for many, many years, who I actually met at an event, boondoggle, if you will. He and I were sharing a beverage one evening after an event, and I was actually presenting at that event. He was very complimentary, which was very nice of him. He introduced himself. We talked a little bit about our businesses. He had a similar business to mine when I was working at UBS, but he owned his business and I did not. And I thought, I was pretty young. I was in my sort of, I would say, early 30s, and I was very, was enjoying my experience and a lot of responsibility that I had at a young age. And then he helped bring me back to and grounded me very quickly when he helped me understand what his success was relative to mine. And I said, oh, I'm doing something different, right? So we thought about it, and I said to him, well, I asked the very same question that you asked me, like, how did you make that choice, right? Because I always thought owning your own business would require, a lot more gray hair, and and you'd have to have a, really established, strong network of people who are going to support you and help you build your business. And he made it clear to me that that's not how it works, at least not for most people, right? Because ultimately making that decision is not one taken lightly. I had young children at the time, so and a wife. And so obviously the decision wasn't simply my decision. It was one that was shared by our family. We were lucky that our children were young, and in terms of our financial obligations, we were very conservative investors over time, and were able to be in a position where we could, certainly in the early years, when the business was just getting started, ride out, the very, I would call them the salad years, the very difficult times, so that we could get to a point where there would be more success, one would expect. So if I didn't have the support of my wife and my family, there's no way it would have happened. So again, I come back to that notion. It's never just about me. I don't want to say it takes a village, but in a lot of ways, you've got to have the support of others. So I think, that cannot be discounted, in terms of that. Beyond that, though, it really is important, I think, in the context of once you've made that choice and saying, all right, this is something that I would really like to do. I think I can be successful. It's really essential. And you know this as well as anyone, given your success as well. You have to have a plan, right? You have to think out beyond tomorrow, the next day, and really put together a business plan. Think about what your marketing plan would be, what your initiatives, where's your target market? Realistically, what's the actual market segment that you're going after? And is it realistic to expect that will continue to grow over time? So doing a lot of demographic work, given our marketplace is largely tax exempt bonds for the most part, but also fixed income more broadly. What does that marketplace look like 5 years from now, 10 years from now? And how large is that marketplace? And can we bring something to that marketplace that would be valued? And that really comes back to that notion of, to use the colloquial term, can I build a better mousetrap? Do we have something unique about what we do that clients will gravitate to and really resonate with? And I felt strongly about that. I was as you stated, I was at UBS for a long time. I learned a great deal at UBS working for a very large private bank. They did a number of things really well. However, the servicing side of the business at a firm of that size is somewhat secondary in a lot of respects, right? And when you're interacting with clients, especially very high net worth clients, we know, and this is really, and I would say central to our firm's strategy, we know that our clients rely upon us. They want to be able to reach us in times of need and concern. And so accessibility is a big part of what we do, right? If a client, and I don't want to name names, but if a client is at a bulge bracket firm and they want to get a portfolio manager on the phone, good luck with that. We know that doesn't happen at very large, well-branded entities that are, in some cases, our direct competitors. So we feel as though our accessibility is an important differentiator because you can reach out to us whenever you need to, right? Your clients can call you and say, look, I'm really concerned about something that's happening right now. Can we get Andrew on the phone? Can we get Clinton Investment Management on the phone to talk about it? And let's think about should we be doing something differently? Is there something here we need to be concerned about or not? Is there an opportunity here? Like the current environment, I would argue, certainly dictates. So hopefully that gives you an idea, but generally speaking, that's really where we're coming from.
So the day you made that leap, right? The day you were like, okay, I guess I'm assuming you resigned from UBS and then you walked out. So talk me through that day. What was it like?
Yeah, it was it's funny. I smile, right? Just thinking about it now. At the time,
I remember mine too. Believe me.
There wasn't a lot of smiling on the day that I left. I'll be honest. I had a lot of friends and close colleagues and relatives say, "Are you sure you know what you're doing? Are you sure you know what you're doing?" And I said, "No, I believe in what I'm doing. I've thought about this for a long time. I planned for this moment." This was again, keep in mind, the timing of this was May of 2007, right? So we were really at the precipice of the financial crisis, right? So, wow, what great timing with the benefit of hindsight. Also, going out and starting your own firm, that was also the peak of Bernie Madoff as well. So the idea of a client moving their assets to a small firm that just started up, you can imagine why there would be some caution on their part. So I'm not going to say that I timed it particularly well, but what I'd say is that, again, it comes back to conviction, right? And it's an understanding of your investment philosophy and process. And I would say I would not have been able to do what I did without the more than a decade of experience at my prior employer, with a lot of responsibility and having been through periods of challenge and disruption and volatility in markets. So being able to bring that experience to clients, no matter whose name was on the door, I think really provided confidence and trust in a way that maybe it would not have been possible otherwise.
That's incredible. I remember the day that I left. It was a Friday. As you know, most advisors, when they leave, it's a Friday, and it's 4:01 is when you kind of walk upstairs. I'm in the parking lot, and I'm a Sylvester Stallone fan, and I was watching on YouTube Sylvester Stallone Over the Top. And if you remember the end, do you remember that movie?
Oh yeah.
And then at the end, when he finally wins that arm wrestling match, And as
Yes.
soon as we won that, it was, I love that ending part. I said, okay, time to go. And I walk upstairs and I grabbed my team. I walked to my manager's office and I walked out. As you know, for me, you walk out with no clients. You literally you just got to get in your car and went straight to my office and I dialed away. And thank goodness, we landed on our feet. So that's why I asked you about that particular day, because it is a moment in your life that's, you don't really, it's like the invisible bridge, you don't really know until you just take that step. And fortunately, the bridge was there for me and you as well. So
Yeah,
awesome
and I
story.
would also add to that, it's interesting because prior to leaving, obviously I asked a lot of questions because I think, talking to others who've made a similar decision like you're doing today and have done, I'm sure yourself, it does give you a sense of confidence to hear how others navigated the uncertainty, because that's really what you're talking about. And that was important for me as well. And again, I mentioned a story because I was talking to the same colleague I mentioned earlier who said, no, you should do this. You'll find it's the best thing you've ever done. He also said, look, when you look back, and this is partly the smile that you detected earlier, you'll say to yourself, man, I wish I had done it sooner.
I was just going to say that to you. I mean, when I was doing my due diligence, that's what everybody said. So
Right.
it is, you're right.
Right.
It is comforting and it gives you the confidence and conviction. So that's actually really, really funny. So when you made that change, started your own firm, when you got to your first billion, right? When you got to $1 billion, did you take the step back and say, gosh, like I just left UBS. I mean, what did that feel like? Did you think about that or not really?
No, that was a big day. Yeah,
Great day.
that was a special day, right? There's something special about $1 billion. In our space, in the fixed income space, it's to say that clients have entrusted you with $1 billion is not a small achievement. Again, I come back to the point. It was something that I celebrated with our team here. In terms of that moment, I think it tells you a little something about my nature in terms of me being in fixed income. I'm definitely a glass half empty kind of person in the sense that I'm constantly trying to manage risk for our clients, for the firm, for our employees, and myself as well. I'm definitely a cautious person by nature. So even on those days when we have those achievements, reaching $1 billion is a big deal. But then it's okay. The reward for hard work is more hard work, right? It's all right. You're at $1 billion. How are you going to get to the next billion, right? And so it's fine to celebrate that moment, and then it's important to say, okay, what is the next goal that we're trying to achieve? And for us, again, I think I approached building my business, I think, a little differently than some, in the sense that there's definitely that an argument, let's just say, for those entrepreneurs who say, well, I'll just build it and they will come, right? I'll put all the pieces in place and we'll just build it and just don't worry, everything will be fine. I have a tendency to move more slowly, right? So our focus in terms of the beginning of the firm was literally just being an office, not far from where I am now, by myself at the very beginning, right? It was literally just trying to keep the lights on, if you will. And then it was building out the team slowly, but piece by piece as we grew, so that we were never in a position, and the firm was never in a position where it couldn't sustain itself, right? If for instance, growth stopped, or we hit a point, and thankfully, with the benefit of hindsight, we've never had that moment, but that was how I managed the risk, right? I just never wanted to be in a position where as a firm, we were overextended and therefore had to start to step back and maybe contract a little bit and then I didn't want to be in that. So what we did was we focused on performance, track record before marketing, right? It was all about driving the performance and building a track record so that clients could see that we are good stewards of their assets. And then over time, that would beget growth, and we'll let the marketing take care of itself as time goes on. And so a lot of folks have said, hey, look, your track record's amazing. How come you guys aren't even bigger? And my argument is because we didn't focus on sales, right? We focused on performance first, which I think is what our clients want us to do.
Right. That's great. That's really great. How do you keep your team happy?
It's a good question.
Happy and motivated.
Yeah. So I'll stop saying good question. I'll just assume that all of them are going to be good questions.
I appreciate that.
What I'll say is that, at any given point in time, right, being a CEO, as you know, and keeping your clients happy as well as your employees are two really important roles. The employees, especially during the pandemic, it was challenging, right? I mean, we all were dealing with the weight and uncertainty of this global pandemic and how it was affecting us personally, how it was affecting our children, how it was affecting our parents and our grandparents and extended families. And so it was so disruptive from the standpoint of just our day-to-day lives, but also emotionally, right? So being connected to the employees, I mean, literally as closely connected as possible physically, being close to one another, I always see great value in. I thought it was very, very difficult to be separated from one another. We were able to navigate it and that moment successfully, and I'm grateful how resilient our staff is in working through those challenges of not talking to one another face to face on a day-to-day basis.
Right.
But we did a very good job, I think, of navigating that. But I say with the benefit of hindsight, I'm so grateful that we are back together now because we are so much stronger as a team, being closer to one another, and being able to have an impromptu meeting or ask a question of somebody who's outside of your office as opposed to having to jump on a Teams call or a Zoom call. Not that there's anything wrong with that.
Right.
I just find it's much more efficient and effective being near one another. So keeping them focused and on the collective goals, like for instance, in our office, we have a whiteboard where we update our growth as a firm. We have specific goals as a business, and we want to make sure that those goals are perfectly aligned with the interests of our clients. So we've been fortunate in that we've been able to enjoy growth in our AUM and our as a business of greater than 40% for the last 3 years running, which is very, very healthy growth. We wanted to sustain that. And so part of that was investing not just in the employees, which are important, but also the infrastructure, right? It's the technology that supports the employees that leverages them to do even more without really having to, take a firm from 8 to 10 employees up to 50, to manage a, slightly more higher level of assets under management. So we're now in a place in terms of our operational infrastructure that our employees have the confidence in knowing that we manage portfolios less than 600 employees. 600 portfolios currently. We could easily go to 6,000 portfolios and not have to change anything from an infrastructure perspective because the economies of scale that we have now in terms of the technology and the investments that we've made in technology has put us in a very different place than we were, I would say, just 5 years ago. But your point is one that it's not lost on me, and I think it's so important that the employees' contribution to our growth cannot be understated, right? And we recognize them on a regular basis. We do our annual reviews of client employee performance. Sorry, I said client, I mean employee performance. But I try to also revisit with them on a regular basis and convene our just to make sure, hey, look, what are you guys seeing? What do you think we should be doing? I do value the input of each of our employees' voices. They all have a voice. We have an investment committee that we meet on a regular basis. Each of our employees has a say in that. We're going through a rebranding not a rebranding, but a brand refresh. So we're building a new website. We're actually going to be tweaking the logo behind me a little bit, which will actually look nicer, a little bit more, I would say, contemporary. That's going to be, I think I mentioned to you. So that'll be completed the next couple of months, but they've had a huge contribution to that. Their voices matter in that regard. And so the outcome of that will be, through their input, which is really helpful. I think it gives them a sense of contribution in a way that maybe, just being at a larger firm and doing your job at the same job every day doesn't give them that opportunity.
I totally agree. One of the things I recognize is, and I'll do this, I'll spend time with each employee and I'll ask them, how are you, right? Anything that's occurring that's bothering you, that's upsetting you, let's be straight with each other. And when you say that, all of a sudden they'll open up to certain things that I didn't realize because I'm running 1,000 miles per hour. And it's a good time just to sit down with them and ask them these types of questions. And then what you do is then all of a sudden you kind of bond tighter because, hey, Phil took the time to sit down with me and ask me if I'm okay, basically. So I've always found the team building and staying connected to them, like you just said, all that's really important to the launching of the firm. And my employees, I tell them all the time, when clients call, they're not getting me right away. I mean, they can if they want to, call my cell phone, et cetera, but they're really getting my employees who are answering the phone first. So they're first line of contact, right? So if they're
Right.
not feeling you're doing a good job and they're not really feeling passionate about the business, that could come through, and that's a negative. So team building, like you said, all that stuff, super, super important. And I just want to go back when you decide to start your own firm, just again, going back to thinking about my audience, right? So when you decide to make this leap, was there anybody out there that, not that they doubted you couldn't do it, but just doubted you because they were concerned about maybe health or, maybe things can go wrong? Were there any doubters out there? And for those doubters, what did you say? And was some of what they said stuck in your head, but then you made the leap and you're in good shape? But before you make that leap, obviously, like you said, there's a lot of uncertainties. So walk me through that.
Yeah, there's always going to be doubters, right? There's always folks who question your judgment. There are those who are in some ways, sadly, rooting for your failure.
Yeah.
There's a lot of Schadenfreude out there, as they say. But there are also those that simply are unsure, right? And therefore may not be understanding of what it is that you want to do, and simply because they would never do what you're considering, right? I mean, I remember when I first started the firm, I went to a conference out in Las Vegas and I happened to hear Steve Wynn speak. And Steve actually was talking at the time. And his quote, which I will never forget, and this was I think it was in June of 2007, where he said, the entrepreneurial existence is a very uncomfortable existence, right? Because you never quite know what's around the corner, right? And there's that uncertainty that you have to learn to really live with, right? It is, as you know all too well, right? It is a roller coaster. I was just having this conversation with somebody recently. Any given day, there's something out there. There's an uncertainty out there that could cause you problems, right? That's all we do all day is solve problems.
Right.
Find them and we try to solve them. That's really what our job is. Right. And so I thought that was a really good example because it really prepared me, at least my mindset. And I'm not going to suggest that, as any entrepreneur, you have your good days and bad days, right? There are some days that are more challenging than others.
Yeah.
But at the same measure, those challenging days prepare you for the future, right? They give you a sense for what you're capable of dealing with. And as you overcome those challenges day in and day out, it provides confidence, right? And it gives you trust both at the team level, right? Because the team says, hey, look, we've seen this before. We've dealt with this. This is how we were able to manage through this process. And we can see the other side of it, right? But when you're looking at it from the perspective of having never experienced it before, people who have never started a business, as I'm sure you know, have no idea what that feels like, right? I liken it to standing out in the rain with no clothes on, right? Like it's just who would ever do that? Why would you do that deliberately, right? And I'm not about to start, mind you, but it's definitely an uncomfortable existence. And it's something that even now, even today, there is instances where you feel that emotion come back, right? And it's managing that experience and keeping balance in your life so that you're not, like at the peak of the roller coaster and at the depths at any given point in time. Keeping that mindset, I think, is challenging, but it's something that's necessary. Otherwise, it's probably not the right place for it, depending on who you're talking with, the right person.
Right, I totally agree. But I think if you live your life where you're really taking care of people, you're always doing the right thing, you're doing the right thing, and you take a step back, make sure you're dotting your I's and you're crossing your T's. You're not just running, but you're really deliberately saying to yourself, compliance, when you do this, whatever it may be, you're always taking a step back and saying, okay, am I doing all the right things? Did I miss anything? And make sure you're always doing right by people. As long as you're doing that, you can't get in trouble. I really truly believe that.
No, I agree. I think the foundation of what you're building is the most important, right?
It is.
As we think about the founding principles of our firm, we get back to that notion of accountability, accessibility, putting the client's interest central in everything that we do. We know if we always make investment decisions, if we make decisions about the business with the client's interests in mind, we'll never go wrong,
Yeah,
right? And
I
so I
agree.
think regardless of what business you're in, I feel like those principles can apply.
It's really true. You know, I remember my grandfather was sitting downstairs in the basement. I don't know, maybe it was, I don't know, maybe 16, 17 years old. And I said to my grandfather, grandfather at the time was 89 years old. I said, Grandpa, you're 89 years old. What's one life lesson, one key life lesson that you learned that you can share with me? Without even a blink of an eye, the guy looked straight at my eyes. He goes, Phil, he goes, always have a clear head. If you have a clear head, you have nothing to worry about in life. I mean, we're business owners. You don't really have a clear head because you always think clear head from a doing the right thing by people, like you said, like client front and center. If you do that throughout your career, you will always be in good shape and do very, very well. I really believe that. It's when you chase the dollar is when you get in trouble.
Totally agree.
So I know from a time standpoint, but I got to get into this because this is what you're really all about. So for my audience who's listening, we're going to kind of do like a rapid fire thing in terms of your expertise, right? So just if you can, municipal bonds, right? What are they? People may say, well, Andrew, that's so boring. Why would I want to invest in municipal bonds yielding 2, 3, 4%, et cetera? So give us a little bit of an explanation of that if you can.
Sure. So it may be helpful to take a step back and just think about it in the context of municipalities in general, right? Everybody has a general sense of what a municipality is. It's your local, recreational department. It's your highway, the pothole fixers. It's your water and sewer authority. It's your municipal projects in town, and it's your school districts. It's all those things. So each of these entities has capital needs. They need to borrow money specifically to fund their ongoing expenses. Using a school district as a great example. They bring a deal, effectively a bond deal, where they need to borrow, let's say, $100 million to renovate an existing school or school district for that matter, or do new roofs or put in a new athletic field. They have to borrow that money. They have the conduit, that is the marketplace, that is the municipal bond marketplace, where they can do that through a loan, effectively carving up that loan, that $100 million into individual bonds, $1,000 face values of each bond that they can sell to the public, right? And the public can support that municipality through the purchase of those securities. So if you bought one bond, which in the municipal bond market, just to complicate things, you can't buy one bond, you have to buy 5 because they trade in 5 bond denominations. But let's keep the math simple. Just say you bought one bond. You will get interest on that bond over the life of the security. So if you bought the bond today, you gave $1,000 to that municipality, that school district uses that money and agrees to pay you interest and the principal back at some point in the future, which is called the maturity of the bond. So, and in the municipal bond market, the maturities can range anywhere between 1 year to 30 years, meaning you could be waiting as little as 1 year to get your money back.
Yep.
Or you might have to wait 30 years to get your money back. And the longer you wait to get your money back, the higher the interest that you would get because you're giving up your principal for a longer period of time. So ultimately, those bonds themselves are supported by taxes, right? We as individuals pay taxes in lots of different forms. When you cross a bridge or you take a toll road, you actually are paying into the form of tolls. That money goes to pay debt service on the bonds that we own, our clients own. Same is true for general obligation securities, which are effectively a fancy way of saying bonds backed by property taxes, right? Your property, portion of your property tax goes to pay the interest on those bonds. So each of the municipalities has taxing authority. They have the authority to raise revenue through raising taxes. And if they need the money to pay back the bonds, what they will do is they will raise taxes. So that's why inherently municipal bonds are an extremely safe asset class. They simply don't default very, very rarely because that authority that municipality has, it's almost monopolistic in a good way. They have the ability to raise revenue almost whenever they need to, right? So muni investors always know that I shouldn't say always, but often, if not always, know there's that support behind it that gives them the sense of confidence that they will get their money back at maturity and interest. And so, to your point, that's the reason why municipal bonds don't yield 15, 20, or 30%, because inherently there's very low risk in them. And
Right.
So investors don't get the benefit of a low risk investment with a high return. That's simply not how investing works.
Can't have your cake and eat it too. So talk us through the risk. Talk us through the risk. So in terms of default rates with investment grade paper, right? Historically, what does that look like?
Less than 1% of the time.
Wow.
So meaning that 99+% of the time, municipal bonds where an investor has done no research whatsoever, they simply threw a dart at a board and bought a bond. They have historically experienced less than 1% default experience within the investment grade category.
Mhm.
So you might argue, well, why do I need a professional manager, right? If I can simply throw darts at the board and find bonds that don't default, why would I want a manager for that? Because ultimately, that's not as simple as it sounds, right? Simply finding a bond that doesn't default, sure, that's possible, that's achievable, that's been done, right? But achieving attractive returns, right, means, well, how do I decide between of those 60,000 issuers out there, which ones are the best performing bonds, right? Which ones are a single A rated bond that might be moving to double A rated, meaning it actually gets some principal return as well as coupon income. So when clients say, hey, look, I come to municipal bonds simply because I don't want them to default, we think they've set the bar too low, right? Most municipal bonds don't default. What we should be looking for is improving credit trends, right? What we should be looking for is opportunities to add value above and beyond simply capital return to you through maturity or interest that you get in a given year. And that's through identifying credits and issuers and projects that offer upside as well.
So it's interesting. So Andrew, before I decided to hire you for my clients, right, I did a full due diligence. I reviewed your track record relative to your competitors. And obviously you definitely came out above them, right? So talk me through why that is, right? There's 60,000 issues out there, like you just said, right? These other managers have been around for a long time and, manage quite a bit of money. So what edge do you have over them?
I'm going to say that our benefit that we deliver to our clients, or the value proposition that we offer to clients, is our experience, right? So we started the conversation talking about the fact that I'm a little embarrassed because it sounds like a long time, because it is, but I've been doing this for almost 30 years. Thankfully, I've again had a lot of folks that I've worked with, my prior mentors at UBS and elsewhere, who I learned a great deal from. I learned how to identify value in the marketplace through apportioning risk in different criteria. So we look at individual bonds, as you know, based on their duration, their sector, as well as their underlying credit quality, what we refer to there as their security. And those three criteria guide our investment decisions. So one of the things that I think makes us different than our peers is that we don't simply put all of our eggs in one of those three baskets, right? If you talk to a lot of different managers, you'll end up finding that they may focus on just guessing which way interest rates go, which falls under the duration bucket. You'll find that others may focus specifically on the security component, which is credit research, right? And others still may say, oh, well, they just focus on trading in and out of bonds, buying low, selling high, which I would put into the sector and relative value category. What we try to do is we try to diversify across all three of those categories and be good as good as possible within each three of those categories, understanding that at any point in time, you may not get every one of those decisions correct, right? We're humble enough to know and have enough humility to know that the broader marketplace can make a fool of us all. And what we do is we diversify our investments along those three categories so that we're not making any one large bet in a client portfolio or strategy. And so that really grounds us in that philosophy, right? Because we know that our peers aren't doing that, right? So at any given point in time, the inefficiencies that we end up finding in the municipal marketplace are identified by those three criteria, right? At any given point in time, there might be an opportunity along the yield curve. We would argue there's one happening right now, right? The flatness of the yield curve. What's that telling us about the future of the economy? How should we be positioned relative to, from a duration perspective, relative to where we think rates are going? But then there's another category within the sectors that, and this is happening right now as well. We look at states as sectors unto themselves. So using New York as an example, because of the pandemic and because it's so inordinately impacted the New York metro region, municipal bonds issued from the state of New York, and this is happening literally as we speak, are at the widest spreads relative to general market paper that we've seen going back to the pandemic and even back prior to the great financial crisis.
Wow.
Right. It's extraordinary, right? Which doesn't make sense when you think about it, because New York is a high tax state. It's actually even higher tax state now than it was just a few months ago, with tax rates going up for wealthy folks in New York. It shouldn't be that way. People who live in New York are going to, especially wealthy people, are going to want to protect themselves from taxes. So the demand for New York exempt bonds is going to be high at some point in the future. It's just not right now because people are concerned about underlying credit quality, which we think is unwarranted, because it is a very, very fiscally conservatively run state. Even though we would argue the taxes are high, the state has a very large, very high funding ratio for its underlying and pension and liability requirements. So that's something that's unique to the sector allocation. And then security selection is, all right, what's going on with the underlying securities specifically? Where do we see the best opportunities across the country as it relates to sectors? Yes, but within the sectors, which particular securities and issuers should we be investing in? So then there's lots of different examples. I don't want to go on too long about that, but those are the three criteria that we use to differentiate us from what our, let's say, our peers are doing currently. And it's served us very well.
So what about the 60-40 portfolio, right? So the 60% stock portfolio, 40% bond portfolio, which has been around for a long time. The study was done in the mid 80s, just talking through in terms of systematic withdrawals for retirement, et cetera. A lot of people calling for that to be dead. What is your view about that?
Yeah, it's interesting. I mean, definitely that up until recently, right, up until a few months ago, where interest rates were extremely low, the argument was, well, if interest rates were to rise, or if the equity market was to fall, and I think it was really the latter more than the former, if the equity market was to fall significantly in value, the fixed income component, that 40% allocation to fixed income, would not protect the investor's asset allocation as much as it had in the past.
Right.
So therefore, the 60-40 model was broken, right? And I think there's some truth in that, right? Because there's no question that with absolute rates as low as they were, that they were not going to protect the portfolio as much as they had in previous periods when interest rates were higher and could have fallen by a greater amount, thereby pushing up the principal value of fixed income relative to, let's say, a drawdown in equities. The difference now, however, is that the argument is, well, if the 60-40 allocation is actually broken, well, then you should have more exposure to what exactly, right? And that's I think where the misconception about the broader market is, and I'm not talking my book necessarily, but a lot of folks have said, well, then you should have a larger allocation to risk assets. I would make the argument it's just the opposite. If that component of your portfolio that you were hoping was going to protect you from the drawdown in your risk portfolio is not going to protect you as much, that means you need to own more of the riskless asset and less of the risky asset. And I think that's where the narrative has been conflicted, right? Because there's those in the broader financial services community that makes a lot of money selling risk assets, and therefore, and maybe not being as forthcoming as they should be in terms of how that portfolio allocation is going to work. Because in my view, if I own 40% fixed income and I own 60% stocks, and stocks drop by 30%, my fixed income only goes up by 5%, well, that's not very good. But if I reverse those and I have 60% fixed income and 40% stocks, and stocks drop by, that same percentage, and you've got 5% on a larger amount, you're protecting more, right? So that's how the math works, and I think that's again how we see it now what's changed obviously is rates have risen, right? So rates have risen a lot in a very short period of time. This is the worst in the recent memory, but I don't want to go into that. And, if you have other questions, but that's where the opportunity set is today.
I mean, it's been the moves have been incredible in the short end. I mean, in the intermediate term, not as much as the long end. So, but the one point that you made was when we spoke about this was the yield to maturity on a portfolio of 5 or 10 years, or your portfolio that goes more of 10 to 12, or where you're more tactical. When you factor in the after-tax return to the client, which we get to 4, 5, 6% approximately, with much lower volatility relative to what stocks can perform. And if you look at the CAPE ratio, which we spoke about, and the returns projected, especially before the downturn, but now markets have rallied a little bit. So now we're getting back up there from a valuation standpoint. The forward returns for equities are like less than 3% over the next 10 years.
Right.
right? So if you think about a tax-free bond portfolio that you're running with a yield to maturity, with the after-tax actual return, it's more than what equities are forecast to be going forward with a lot less risk. And that's more about your point. People don't think that way, unfortunately, but that is a very good point that you're bringing up.
Yeah, and I think it's important today in today's market, maybe more than ever, right? Because we just sent out a piece which you may have seen, but we were just saying that these periods of rising rates tend to be short-lived, right? The longest in the last 30 years has been 10 months, and that was in 1994.
Wow.
Right? Until yields kind of snap back.
Right.
So it's one of those scenarios where I think we get conditioned in the marketplace to assume that whatever is painful to us is the first time it's ever happened, because it feels fresh and the wound is fresh.
Right.
But what we have to remember is that over the long term, right, as clients think about investment horizons, our investment horizon is not 3 weeks, 3 months, or often even 3 years. It's usually 5 to 10-year investment horizons. So it's over that time period where we encourage clients to think about it, because what's likely to happen in the next 3 to 5 years is we're going to have a recession, right? The recession is coming. Could be as soon as the end of this year by some people's measures. And that argument we could debate, but it's likely in the next 3 to 5 years, and probably in the next 2, to be candid. And it's that scenario where folks are now able to get into the marketplace or add to their allocations at higher yields, which we know we're going to ultimately see rates come down in the future. They will have to, as the economy slows. So that's where we see opportunity.
I agree. I would agree with that. So I mean, I'm forecasting actually recession at the end of this year, beginning of 2023, for my reasons. Again, we could talk offline about that, which we have been. So last question for you, Andrew, going back to what we talked about regarding your life and you starting your own firm. How do you balance your life with family, your hobbies you enjoy, and then obviously you have your firm, your business? How do you balance life?
It's a challenge. I'll be candid. And I'm sure you know, right? It's almost impossible to not bring work home with you when you're an entrepreneur, an owner of a business. It permeates every thought that you have almost every day. My wife is constantly telling me to put my phone down. But the nature of what's that?
You too?
Yes, it is a problem. I'll admit it. I am definitely attached to my phone in the office more than she would like. But at the same measure, I think it's important to remember, there is a defined beginning and an ending to your day, right? I'm constantly reading, as I know you are, and because we want to make sure that we're on the cutting edge of the research that we're trying to both interpret on our own and then convey to our clients in a way that's understandable. And we want to act on that to the extent that it's new information that can be helpful to our strategies and to our clients. But we also want to make sure that there's balance, right? So the good news is we're in the over-the-counter market, which means there really is no opening or closing to our day, right? It's whenever somebody's available to a trade, we can do a trade. But I want to respect the work-life balance of our employees. I don't require employees to respond to texts at 3 a.m. in the morning just so I know that they're engaged. That's not a healthy work environment, in my opinion. I do enjoy, again, the independence that as a business owner I have, where I can actually get to my kids' events and athletic events or otherwise, let's say play or anything. There's something great value to me about that. And so that was a primary decision when I left my previous employer. I said, look, I wanted to have more control over my own life. And there is something very special about that. At the same measure, what I didn't really understand, and I now understand more clearly, is that there is an offset, right? There is a counterbalance to that, is that there are certain things that are not within your control as a business owner as well. So you have to understand that and sort of take that in stride.
I agree.
But I totally agree. I think the balance, the work-life balance, is most important, right? And making sure that you have defined beginning and ending to your day. As an entrepreneur, there's never a moment where you're not connected to a degree to what you do. But vacation's important too, just to balance.
I agree. Well, Andrew, it's been really terrific interviewing you today. I continue to learn more and more about you when we talk. I appreciate all you do for us and the firm. You're always right there for us when we have questions. So you've really been amazing. just to take away from my audience who's listening in here, speaking to Andrew, if you're thinking about going off on your own, Andrew talked about having a plan, right? Know what your target market's going to be, know what your audience is going to be, and know what value you're going to bring to the world. That's number one. Number two, he talked about doing your due diligence, speaking to as many people as possible so you can build conviction about what you're looking to do and have confidence they take that leap of faith. He talked about being connected with his employees, understanding the collective goals as the firm, keeping them happy, which, from my experience, that's super, super important. And trying to balance life as we're all trying to, as the best of our ability. One of the benefits about being an entrepreneur and a business owner. So again, Andrew, I want to thank you very much. You've been awesome today, again, as usual. I look forward to speaking to you shortly. We could debate a little about the recession thing, if it's coming sooner than later or later than sooner. Look forward to that debate, and I'll speak to you soon. Be well. Enjoy everything.
My pleasure. Thanks so much for having me.
Pleasure. Take care, Andrew.
Take care.
Bye, everybody.